The more funds people buy to feel safe, the less diversified they often end up. Open a careful investor's portfolio and you'll see it. 8, 10, a dozen different funds. And inside almost everyone, the same fistful of stocks. They own Apple 3 times and don't know it. They think all those funds add up to protection. What they've really done is quietly hire themselves back as a stock picker, without noticing, without ever meaning to, and paying for the privilege in time and money. It's the most reasonable sounding mistake in all of investing. The belief that more funds must mean more safety. So, how many funds do you actually need? Let me open the hood and show you what you really own. Here's the whole thing, up front. The number of funds you actually need is far smaller than almost anyone guesses. Closer to 3 than 13. And most of the funds people stack past that don't add safety, for one simple reason. They overlap what's already there. They're a bet nobody knows they're making. The good news, the fix isn't a research project. It's a recipe with about 3 ingredients. But first, let me prove the problem is real. 3 ways. What those funds actually hold, the one reason adding more of the same can't help, and then that recipe. Watch how it happens, because it happens to almost everyone, one sensible step at a time. You start exactly where you're told to, an S&P 500 fund, solid. Then you read you can own the whole US market in a single click, so you add a total market fund. Then a video swears the real money is in growth, so you add a growth fund. Then tech is the future, obviously, so you add a tech fund. 4 funds now. It feels like a real portfolio. It feels diversified. Then you lift the lid, that total market fund. The S&P 500 is about 85% of it. Most of that second fund was already sitting inside your first. The growth fund, the tech fund, both led by the very same names, Nvidia, Apple, Microsoft, the ones already crowding the top of the first 2. Stack all 4 together and depending on how you split them, a single stock, Nvidia, can quietly swell to more than 1/10 of everything you own. You didn't buy 4 different bets. You bought the same few giants, 4 times over. 4 funds doing the job of 1. Maybe that doesn't bother you yet. More of the winners. Where's the harm? Here's the harm. Diversification is supposed to mean that when one thing falls, the others are there to hold you up. But funds built from the same stocks don't take turns falling. They drop together in the same breath. And they do it on the one day you were counting on them not to. The safety was never really there. It only looked like it was, spread thin across a longer list of names. And it goes deeper than one bad day. A single fund that owns the whole market already holds basically everything. That is the diversification. So when you stack more funds on top, you're usually not adding companies you didn't have. You're just quietly reweighting the ones you already own. And if those funds all lean the same way, towards whatever's already biggest, you can end up more concentrated than the plain market, not less. You did it by accident while trying to be safe. And concentration you didn't choose is a bad trade, for a reason most people never hear. Researchers took a broadly diversified strategy and a stripped-down 50-stock version of it, and built the two to have the exact same expected return. Over 5-year stretches, the broad version delivered its expected result about 92% of the time. The 50-stock version, same expected return, delivered it only 63% of the time. The average didn't move an inch. What moved is the spread. The fewer, more overlapping bets you hold, the wider the range of where you might actually land. More ways to end up well below the market, and not $1 of extra reward for the risk. It's the same reason a tiny handful of stocks drive almost all of the market's long-run gains. The surest way to hold the winners is to own the whole market, not a slice of it that leans one way. So more funds didn't spread your risk. They concentrated it and hid it behind a longer list. Let me put a face on it. Every Sunday morning, coffee going cold, beside him, he opens the spreadsheet. He reads the research, checks the news, rebalances, shaves a little here, adds a little there. 12 funds, all lined up in neat colored rows. He is, as far as he knows, the most carefully diversified person he has ever met. And he's a little proud of it. Then one afternoon he runs a simple X-ray, one tool, one click, that shows what all 12 funds are actually holding underneath. And the screen comes back almost all one color. 80% of his money is the same handful of American tech giants he could have owned in a single fund, bought once and never touched again. He hadn't diversified anything. He'd hired himself back as a stock picker and paid for it in Sunday. And the effort was quietly working against him the whole time. Across large studies of everyday investors, the ones who trade and tinker the most tend, on average, to end up behind the ones who did almost nothing. Not because they're unlucky, but because all that activity was only ever stirring the same pot. So how many do you actually need? Think about cooking one good meal. A great dish takes a few real ingredients, not the whole spice rack tipped into the pan. A sound portfolio is the same. 3 jobs and that's it. 1. The whole world. For growth, a single global stock fund already holds close to 10,000 companies on one tidy line. 2. A shock absorber for the years that hurt. That's bonds. In 2008, while stocks fell about 37%, a broad bond fund actually rose, and a simple blend of the two dropped only about half as far. 3. A cushion you can reach on a bad day without selling anything. That's cash. Growth. A shock absorber. A cushion. For a lot of people, that's 2 or 3 funds. Sometimes a single all-in-one fund that even does the rebalancing while they sleep. And every ingredient you're tempted to pile on past that, stop and ask one question. Is this a genuinely new flavor? Or am I just shaking more salt onto the same plate? 2 honest catches, and I won't skip them. First, extreme simplicity has a price of its own. If you specifically want more of something, smaller companies, a particular region, a little more or a little less risk, that's a fair reason to add a fund or two on purpose, with your eyes open. Adding on purpose is a completely different act from adding by accident. And second, the line I won't cross. There is no single number that's right for everyone. How old you are, how steady your paycheck is, how you'd actually behave when the screen turns red. Those change the answer, and I can't see yours from here. So take all of this as the shape of a good portfolio, not a prescription for yours. This is education, not advice. And I'm deliberately not naming a single product, because the right specifics are a conversation for you to have, not a line to copy off a video. So here's something you can do tonight, in 5 minutes. Take the funds you already own and drop them into a free overlap tool, the kind that shows you what's really inside each one. Look at how much of fund number 2 is already sitting inside fund number 1. If 2 of them come back 80, 90% the same, they were never 2 bets. They were 1, and you've been paying and worrying for 2. So here's the whole thing in one line. The number you need is closer to 3 than 13. More funds was never more diversification. It was just you quietly picking stocks again, working harder to end up with less. Own the whole world, add a shock absorber, keep a cushion, and then put the spoon down.